Hello there, Ado from Resource Investment Media. Today I want to talk about a topic that has captivated my mind for quite some time, and that has caused me a bit of concern. And I guess that is the paper market, and essentially how much paper there is out there and how little there is backing that paper. You could even put out a bold statement and say that we have become an empire of paper, or kings of paper if you prefer that statement. Now, in which way do I think this hurts the economy, and why do I think this is something that you should pay attention to as an investor? I guess the first thing is to realize how obscenely large the paper market is. You don't just have to look at precious metals, gold and silver, where the paper market for silver, I believe, is between 200 and 250x the physical, and for gold it's well above 100, meaning that you have a ton of paper just being traded from hand to hand, and you have very, very little actual commodities. There is a large paper market for oil, for many commodities. Many of the most liquid and traded commodities have very, very large paper markets. Okay, that's one aspect where we have a risk of derivatives, or paper as you can also just call it, being used to mitigate price discovery, at least on a short-term basis. The banks themselves, I guess you could say that they are the institution of paper, because they have very little tangible in their business model except maybe the building that they're located in. Otherwise, it just tends to be a lot of paper. Now, the banks themselves are, if we're the kings of paper or the emperors, I guess the banks could almost be referred to as the gods of paper, because it is not uncommon today that you will see a bank have speculative derivatives positions that are actually well above 100 times their equity. Now the bank, they're a little bit tricky in this. They'll just show the net of those positions. But obviously if someone can't pay, you're the guarantor. And whenever you, in a credit shock, merely have 0.3, 0.4% of equity in comparison towards total derivatives position, which is what many of these banks have, obviously, a credit shock does not have to be that large for you to be immediately insolvent. So a very, very small event could make a bank insolvent. Or I shouldn't say small event, but at least by numbers basis, when you compare their derivatives position towards their equity, you realize that the shock doesn't have to be large from a percentual terminology for them to be in real trouble. And that is because they've just been able to issue paper. And they have a spread on it. That's how they earn their money. They earn their money also on borrowing. I guess you could say they borrow short and essentially buy obligations that are long, meaning paper here too. We've come to the level where derivatives and paper markets in general have become a problem when it comes to actual price discovery. And you would struggle to find a market that functions perfectly because of these aspects and because of our willingness to accept paper for everything. And with that, even what some people would say, well, I understand that, and that's why I buy physical. That's why I store it myself. I'm practicing what I preach, and I hope as many of you do that at home as possible. I genuinely do, because I think that's going to be very important over the coming decade. Now, let's even look at something else that perhaps many of you'll be involved in the paper market, but perhaps you won't even be aware of in which way you're facilitating it. Because essentially when you buy stock, you own the stock, right? You buy it, it's on your bank, it's probably in a little box with your name on the certificate or whatever you might imagine. Usually if you buy stock, especially if you're overseas, first you buy it from your bank, then your bank is really using, I should say, a brokerage firm that is often in the States. And then that brokerage firm, in essence, is using a clearinghouse. And the clearinghouse itself is the one that will actually clear the very certificate of stock ownership. And the clearinghouses themselves, too, have a bunch of speculative derivatives positions, meaning they're also exposed to issuing paper left, right, and center. So if the clearinghouse went under, obviously, you'd be in somewhat of a trouble. Meaning that what you really have when you own stock is you have a claim towards the bank in which you own the stock. it would be hard to claim that you are the legitimate owner in that essence, because obviously if the clearinghouse goes bust, that's a problem. So your ownership is not absolute. It carries significant counterparty risk that many people are unaware of simply because it hasn't displayed itself in such a long time. When you read old economic textbooks, brilliant ones such as The Intelligent Investor, you'll actually see warnings against clearinghouses simply because I believe in the 70s it was, they ran into quite a bit of problems. We haven't had that at a larger scale since. But that doesn't mean that the investor is not exposed to the somewhat insane nature of just issuing paper derivatives left, right, and center once again that these clearinghouses are engaged in. And I guess the natural follow-up question when you look at how much paper is being issued by banks, how essentially paper markets have distorted price discovery in commodities, I guess one natural question would be why are they doing it? And I guess the simple answer is it's a very, very good way to make money. You take a small spread, paper is liquid, it trades often, and you can make money on it. So in essence, while the banks are the gods of paper, their power is, I should say, almost dependent or a direct effect of our willingness to accept paper instead of the real good, the real commodity, the real asset. And you realize once you see how much paper there is in comparison to the assets, this is a game of musical chairs. And eventually, some people who have paper and who think it is as good as the commodity, the resource, the asset, are probably going to be in for a rude awakening. This decade, in my very, very humble estimation, is one where counterparty risk is going to be of crucial essence. And you really need to ask yourself, what do I own? Do I actually own it? What are the mechanics of this financial product that I have bought? Would it be better for me to buy something else that, while not being as liquid or as easy to sell, perhaps carries a much, much higher degree of certainty and much lower degree of actual financial risk? Now, to give a conclusion on the matter of the paper market, I guess the first one would be, I think it's been a market that has functioned for a very long time, and people have become very comfortable by the mere fact that it hasn't collapsed. I think we're starting to see cracks of this. I think that in an inflationary environment and an environment where credit risk all of a sudden becomes a issue in a downward slope for the equity market, where you can't just issue new shares and get money, and you actually have to be able to get money from a tighter credit market, I think you will see some things break in this regard. And I think it'll be, unfortunately, a very expensive lesson for many to learn. Now, I hear a lot of these examples today with regards to counterparty risk. Well, if I lend my precious metals out, I can get a yield. If I lend my Bitcoin out, I often hear that one, I can get a yield on it. And as an investor, you always have to ask yourself, when you're giving up self-custody, you're acquiring counterparty risk, and how is that counterparty risk generating the yield that you are getting? What risks are they taking? Are you aware of the risk that they are taking? Can you properly calculate them? So natural basic questions will help you avoid a lot of the pitfalls in the paper market. But in general, us as a society, the day that we come to have a reckoning with the fact that we have so much derivatives, so much paper, and so little things behind it, is going to be a grim day. Because a society that is purely built on narrative, when that society faces arithmetic, man, that's a tough day. That is a sad day when a society that has purely built itself on an aspect of narrative sees that narrative deflate. That's not a beautiful sight, and it is a bit gloomy to talk about that in an essence, but I do think that you as an investor can make very, very simplistic decisions that will help you perhaps be more of an observer of this than a direct victim. So if you enjoyed the video, do not hesitate a single second to like and subscribe. Cheers.